Liquidity is the oxygen of the financial system, silent, invisible, and taken for granted until the moment it disappears. Every market rally, every debt bubble, every stock surge, every crypto boom, and every economic miracle is built on one thing: the availability of cash and credit when the world needs it most. But the truth is far darker, because liquidity is not created naturally. It is engineered, restricted, released, tightened, and weaponized by the most powerful institutions on Earth. Banks, central banks, hedge funds, and sovereign lenders manipulate it like a global breathing system, expanding it in times of peace and suffocating it in times of crisis. And today, the financial world is entering the most dangerous stage, a silent liquidity drought that the public cannot see, but which experts fear will trigger the next global collapse. This documentary exposes the hidden mechanics behind liquidity, the quiet machinery of credit creation, and the invisible drain that is now destabilizing global markets. The warning signs have been flashing for years, yet almost no one understands what they truly mean. Because markets don't crash when prices fall, they crash when the cash behind those prices disappears. And that moment is already beginning. Every bull market in history shares one secret driver: abundant liquidity. When central banks lower interest rates, money becomes cheap. Investors borrow more, companies leverage more, and asset prices inflate like balloons pushed by an invisible hand. Liquidity floods into stocks, bonds, real estate, crypto, commodities, and corporate debt, creating what appears to be unstoppable prosperity. But prosperity built on liquidity is an illusion, because it depends entirely on confidence. As long as investors believe cash will keep flowing, the market behaves like a rising tide carrying everything with it. But when liquidity peaks, when borrowing slows, when banks tighten credit, when central banks pull back, the tide stops rising, and the system enters its most fragile state. What looks like unstoppable growth is really a carefully timed injection of credit fuel that can be withdrawn at any moment. And that withdrawal is beginning now, quietly, globally, relentlessly. Behind the scenes, the world's credit pipelines are clogging. Bills are increasing, borrowing is slowing, and banks are becoming more selective than ever about who gets access to capital. Small businesses are applying for loans and being rejected at the highest rates since the 2008 recession. Consumers are relying on credit cards, not for luxuries, but for basic survival: food, fuel, rent, electricity. Meanwhile, governments are drowning in record-breaking debt levels, forcing central banks to choose between inflation and insolvency. And when banks fear losses, they pull back. They issue fewer loans, tighten conditions, and quietly shut the doors on the very system that depends on them. This is how liquidity vanishes, not with a loud crash, but with a slow, creeping suffocation. And once the credit channels dry up, everything else follows. The greatest liquidity crises in history began with one simple event. Banks stopped lending to each other. In 2008, it happened almost overnight, and the system collapsed in days. Today, analysts are seeing the same fractures return. Interbank lending rates are rising, trust is fading, and institutions are quietly hoarding cash. This isn't publicized, it isn't debated on television, but inside the financial system, every institution can feel the fear. Banks know that liquidity is fragile, and they know that one wrong move could trigger a chain reaction. So they hold back, they restrict lending, and they protect themselves first. When banks choose self-preservation over liquidity, the entire system becomes a ticking bomb. Because if banks won't lend to each other, they won't lend to the world. For decades, central banks acted like superheroes. When markets panicked, they printed. When liquidity dried up, they injected. When economies stalled, they flooded the world with money. But today, they are trapped. Inflation is too high, government debt is too extreme, Interest rates are too elevated to cut without triggering another inflation wave. The world has reached a point where central banks can't fix both problems at once. They cannot supply liquidity without creating chaos. For the first time in modern history, the global financial system may face a liquidity crisis that central banks cannot solve. And that is the most terrifying scenario of all. Most people think banking happens inside regulated institutions, but the real danger lies in the shadows. Hedge funds, private equity firms, money market funds, and offshore lenders now control trillions of dollars outside the reach of traditional oversight. This shadow system thrives on liquidity, but it also collapses without warning. When one giant fund fails, another faces losses, and panic spreads like wildfire through a web of interconnected obligations. But because shadow lenders aren't required to reveal their true risks, the world often discovers the danger only after it's too late. The 2027 and 2030 liquidity shocks that experts warn about will likely start here, in the unregulated corners of global finance. Once one domino falls, the chain reaction becomes unstoppable. Companies around the world are suffocating under record-high levels of debt. For years, they survived on cheap interest rates and easy lending. But now, with rates surging, their debt is becoming unpayable. Corporate defaults are rising at the fastest pace in a decade. Zombie companies, firms that cannot survive without constant borrowing, are collapsing one by one. Every default destroys liquidity. Every bankruptcy reduces credit supply. Every failure pushes banks to tighten further, accelerating the liquidity collapse already underway. This is not a cycle of fear. It is a cycle of mathematical certainty. Markets don't fall because sentiment turns negative. They fall because there is no cash left to support them. The moment liquidity reaches its breaking point, forced selling begins. Funds liquidate positions to meet margin calls. Investors sell not because they want to, but because they must. Prices fall, losses surge, and more investors are forced to sell. This is how markets truly crash, in a spiral driven not by emotion, but by mathematics. And when liquidity vanishes, the spiral is unstoppable. Economists warn that the next global collapse will not be triggered by inflation, unemployment, war, or politics. It will be triggered by a systemic failure of liquidity. A moment when the world realizes that cash, credit, and capital are no longer moving fast enough to sustain the system. It will start quietly, with a missed payment, a failed bond auction, or a sudden spike in funding rates. But it will spread rapidly as banks panic, credit disappears, and markets freeze. This is the invisible threat the public cannot see until it's too late. The liquidity crisis is no longer a prediction. It is unfolding in slow motion. The only question left is not if the system breaks, but when. Because liquidity does not vanish with a bang. It evaporates like water in a drought, slowly, silently, and then all at once. The world is approaching that moment. And when it arrives, the global financial system will face a shock unlike anything in modern history. This is the threat the world isn't watching, and the one it cannot escape. The first stage of a liquidity collapse never looks like a crisis. It looks like glitches. A delayed transfer here, a frozen money market fund there, a sudden shortage of buyers at a routine bond auction. News anchors dismiss these signs as technical issues. But inside trading floors, alarms begin to ring. Market makers widen their spreads, hedge funds quietly unwind leverage, and banks start calling in loans earlier than usual. Liquidity, once abundant and taken for granted, begins to behave like a scared animal sensing danger. It retreats. It hides. It becomes unpredictable. A single failed transaction triggers a chain of failed settlements, each one amplifying the next. Investors who once handled billions per day suddenly find there are no buyers on the other side of their trades. It's like an entire global marketplace turning into a ghost town, silent, hollow, and full of fear. And in this silence, the real danger begins. Confidence evaporates. Confidence is the currency behind liquidity, and when confidence breaks, no amount of cash can save the system. This is the moment when the unraveling becomes irreversible, and the world realizes that the financial system is far more fragile than anyone imagined. When liquidity dries up, credit collapses, and when credit collapses, the global economy begins its descent. Businesses that depend on daily cash flow suddenly find themselves unable to refinance loans that were once routine. Factories halt production because suppliers are demanding upfront payment. Retailers reduce inventory because warehouses won't release goods without immediate settlement. Families delay major purchases because banks are denying even the safest loan applications. This tightening spreads across continents like a financial drought choking every sector simultaneously. Even governments feel the pressure, as investors demand higher yields to compensate for growing risk. Bond markets, once the foundation of global stability, become unstable battlegrounds of fear and uncertainty. Every failed debt auction sends shockwaves through the financial world, forcing central banks into impossible decisions. Do they inject liquidity and risk runaway inflation? Or do they hold back and watch credit markets collapse into a death spiral? This is the stage where economies begin to break, not from lack of demand, not from unemployment, but from the simple fact that money stops moving. And when money stops moving, everything stops with it.